Joining me now is Independent Advisor Alliance Chief Investment Officer Chris Zaccarelli. Chris, good morning. And this really is that pivot point when investors start to look at the second half of the year and start to ask themselves that they should be maybe doing some repositioning. Do you have an outlook for the second half of the year? And also, because it's an election year, do you think that the market is going to perform strong?
Yeah, I think taking that last point first, look, in election years, we typically do have a strong market. There can be pullbacks along the way, and we do think right now, given how expensive the market is, right, it's trading around 21 times earnings. You look at the 30-year average, it's closer to about 16.6. So the market's pretty expensive, and because of that, we think there's going to be some opportunity for volatility along the way. It's an election year. As we get closer to the election, we'll go through the debates, as you were talking about. They're going to see some uncertainty, and the market doesn't like uncertainty, so we could easily have some pullbacks. Stakes are a lot higher because given higher valuations, as we see some of that inflation data later this week, that could cause a negative surprise. Conversely, if the data comes a little better than expected, people will start looking ahead to Fed rate cuts. So we think there's a lot of opportunity for volatility higher or lower, but we do think if the economy stays strong and stays out of recession, that we'll still see this bull market continue. It just won't be a straight line from here to the end of the year.
But you also talk about the weakening consumer, and we've had several of our guests, Stephanie Pomboy in particular, that has really raised the alarm on that the consumer is stretched. The consumer they're saving less money, their credit card debt is higher, their interest rates on their auto loans, that is higher. And we've seen now the data, and I'm pointing to the retail sales number, that are really starting to show us that that is actually true, because that isn't even an inflation-adjusted number, and still it came in weaker.
Yes, that's absolutely true. And you look at, how has the economy continued to keep going without a recession, given that the Fed has raised rates so much in such a short period of time? And the answer is the consumer. Consumer spending, I think, is far surpassed what any of us would have believed would have been possible even a couple of years ago. But as that consumer begins to weaken and spend a little bit less, and to your point, we've seen some weakening in terms of looking at credit card data, delinquencies going a little bit higher, looking at the spending numbers starting to come back down, even adjusted for inflation. So really with that weakening consumer, that is a risk. That's one of the things that's been really keeping the economy from falling into recession. And so we want to watch that closely, because any weakness within the consumer could be weakness in the economy and therefore the market as well.
I want to bring in Luke Lloyd real quick, because Mark Tepper and you have both mentioned this, and that's why I think it's an important point to bring up as we look at the broader picture for the second half of the year.
Absolutely. I go back to two things. You have people still have jobs. People can borrow against those jobs to take out loans. And on paper, their assets are up a lot, whether it's the stock market or housing. I'm going through the process of selling my house right now, and I'm listing it for 35% more than what I bought it for just 4 years ago, right? So if you have those assets you can borrow against, you can keep the economy going. My question to you, Chris, is what happens if that gets wiped away? Is the downturn in the market or downturn in asset prices, could that fuel unemployment down the road?
Yes, absolutely. To the extent that you believe in the wealth effect, and I think there's some pretty good evidence that that's a true thing, with housing prices higher, with the stock market higher, if people feel wealthier, and they are on paper, then they'll continue to spend. And so that's a virtuous cycle on the way up. It can also turn into a vicious cycle on the way down. So if the stock market starts to come back down, if there becomes some weakness in the housing market and people feel a little bit more concerned, a little bit more worried about their financial position, then they may cut back on spending. And that would lead in the other direction, whereas people start to cut back on spending, lower corporate profits, companies start to look for layoffs, unemployment goes higher, and that's how the cycle reverses. Now, we're not calling for that imminently, but at some point, of course, that will happen. It happens in every cycle. So I think you're exactly right. The wealth effect has been working on the upside, which is really good. But as things turn around or peak out, that's where you have to worry. Are we going to go into a period where we stall? Or are we going to go into a period where we start to have that pullback? Right now, I think it's inconclusive, but that is something to watch for, absolutely.
A market pullback is never a bad thing. I mean, and that is where many of the smart money guys will go out there and look for opportunities to buy in when you see those dips. But Liz Peek, you've got a question. Go ahead.
Good morning, Chris. So I am hearing a steady but quiet drumbeat of some disenchantment with AI. Not that it isn't important, not that it isn't coming, but the companies really aren't embracing it quite as fast as expected, that maybe the earnings aren't going to be quite there. What do you think about that? If we have a change of leadership and if the big AI names begin to get battered a little bit, what does that mean for the overall market?
Well, that's a really good point, because that's the main theme in the market right now. AI is what seems to be providing a lot of interest and a lot of excitement in the market in terms of those big tech leaders. And so, all of those tech companies have lots of other businesses, and they've been very successful and done well up to this point without AI. But AI is where a lot of the excitement is. Obviously, you look at the most valuable company in the world, it's the chip producer for AI. So that is a big theme, and that's something that really has pushed the market potentially to higher highs than we would have expected otherwise, just given the current economic climate. So, I don't know exactly where AI is going. I don't think any of us do for sure, but there has been a lot of excitement behind it. So if some of that excitement does come off the boil, let's say, then that could lead to a little bit of a pullback in those names, as well as on the spending front. I think, AI is going to be a double-edged sword where we may see a lot of productivity gains and we may see a lot of benefit from it, but we don't know what other, pitfalls and challenges lie ahead as well. And so it's one of those things where you got to be careful what you wish for. If you put all your eggs in the AI basket, and it turns out that isn't the place to be, things could turn a little bit negative.
40% of the market gains have been in the AI basket. So you're actually preaching to the choir on that one as far as the three of us go this morning. Zaccarelli, it's great to see you, Chris. Thank you.